I'm Laurent Calvet, Head of Fixed Income Business for Tikehau Capital. Current market stress primarily transmits via higher energy prices, energy shock, with growing fears of a stagflationary environment. Two macro channels. The first one, higher inflation expectations, leading to higher rates, a curve flattening because of anticipation of more restrictive monetary policies. And the second one, negative pressure on growth and impact on corporate earnings. If the conflict escalates or persists, the impact of those negative outcomes will be felt at best medium term in corporate earnings and growth figures. But for now, default rates are contained and we see an underperformance of all the most energy intensive sectors such as construction, automotive, transportation, and chemicals. Notable fact is that after almost 3 years of continuous inflows into the asset class, we've seen a reversal in March with outflows to the tune of minus 1.5 billion euro year to date. But at this stage, this reversal does not undermine the technical backdrop of the market where you have excess liquidity still looking to be invested in regards to a primary market activity that is still muted. Regarding risk premium, we currently sit around 300 bips, which is roughly 40 bips wider than the pre-conflict tights, which is to some extent not a lot or a contained widening in regards to all the risks if the conflict persists, and still below its historical average of 380 bips. So from a historical perspective, risk premium appear to be tight, although they adequately compensate for all the upcoming defaults absent a recession in Europe. So said differently, if Europe enters a recession, clearly current risk premium do not compensate enough for the risk. But as the rates component have increased, the all-in yield of the asset class, which is the risk premium plus the risk-free rates, is now back around 6%, which is deemed to be attractive, which is kind of the high point since mid-2024, except for the one-off episode of Liberation Day. So how to gain exposure to the European high yield in the current context? We have two funds. First one, Tikehau European High Yield, which is a conviction-based bond-picking fund based on fundamental analysis with a contained duration to shield your investments against the volatility of long-term rates, away from index tracking, non-benchmark fund, and with very little, if no, exposure to the at-risk sector in the current environment, again, construction, chemicals, transportation, automotive, and which currently offers a yield around 5.5%. And the second one, Tikehau 2031, which is exactly the same investment philosophy of Tikehau European High Yield, with a maturity date in 2031. So a progressive de-risking from 2029 onwards and a greater visibility on the risk-reward profile of the fund as the maturity approaches, and which currently offers a yield of around 5.8%. As a conclusion, we're in the midst of an energy shock with growing fears of a stagflationary environment. So inflation expectations are increasing, long-term rates are increasing, and a negative impact on growth is to be expected if the conflict persists. Now, spreads have widened, but the widening has been pretty contained, and the all-in yield coming back closer to 6% has become attractive again. Now, in the absence of a very strong macroeconomic view, we continue to favor an allocation on European high yield, disciplined with contained duration and very selective on sector allocation, either via Tikehau European High Yield or Tikehau 2031, depending on your horizon and your need for visibility.